All right, let's talk about something in the government budget that sounds super complicated, but is actually, well, critical for all of us to understand. It's called capital receipts. Now, the big question is this just some clever accounting trick, or is it a sign of something a lot more worrying? Let's figure this out.
You know, this quote just nails it, doesn't it? It perfectly frames the entire problem we're looking at. It's a really simple way to think about a huge concept in government finance. It basically forces us to ask, is the money we're getting today setting us up for a big problem tomorrow?
Okay, so to get to the bottom of this riddle, we first have to crack the code. We need to decode the jargon and get a really clear idea of what capital receipts actually are.
So here's the official definition. The most important thing to get here is that this isn't income like taxes are. This is money that either has to be paid back, think of a loan, or it's money that comes from selling something the government already owns. So yeah, there's always a catch.
You can think of capital receipts as coming in two main flavors. On one side, you've got the debt-creating kind. This is literally just borrowing money. And on the other side, you have non-debt creating receipts. This is when you get cash by selling off an asset like a public company. That's a process you'll often hear called disinvestment. And believe me, knowing the difference between these two is absolutely everything.
Let's be super clear about why this is a problem. Imagine if the biggest chunk of a government's receipts is just borrowing. That's basically the same as you taking out a huge bank loan and telling everyone it's your salary. I mean, you'd never run your own life like that, right? So why would it be okay for a state's budget? It gives a totally wrong picture of its actual financial health.
Okay, enough theory. Let's see how this stuff actually plays out in the real world. We're going to take a peek at the actual budget numbers for the state of Meghalaya for the year 2025. So you open up the budget documents, and bam, there's this number, over 3,400 crore rupees, all listed under capital receipts. Now, at first glance, that sounds fantastic, right? A huge amount of cash coming in. But now we know to be a little skeptical and ask a very important follow-up question. And this is it. This is the critical question we have to ask. Of that big, impressive number, how much of it came from selling something valuable, and how much of it is just, well, more debt?
And here's the answer. The reality is pretty stark. This chart shows that pretty much the entire amount, we're talking around 99%, isn't from selling assets at all. It's just new borrowing. The vast majority of those so-called receipts is simply debt. And hey, you don't have to just take my word for it. You can be your own budget detective. It's actually pretty simple. Just look up the budget documents for your state or the country. Then ask yourself, did the government announce any huge sales of public companies or land? If the answer is no, then you know that almost every single rupee in that capital receipts column is a loan.
So what's the big deal? Why does any of this matter? Well, it matters because this whole practice creates a completely misleading picture of a government's financial health. It basically hides the true cost of all its spending.
This table really breaks down the whole sleight of hand. The illusion is that the total receipts look nice and high, which makes it seem like the budget is balanced. It looks like we're paying our bills with the money we're earning. But the reality? The reality is that a huge piece of those receipts is new debt, and we're just borrowing money to cover our everyday spending.
The source material we're looking at uses these two phrases that just perfectly capture the danger here. An illusion of solvency, that means we look like we can pay our bills, but we actually can't, not from our real earnings anyway. And artificial prosperity. That means our lifestyle, our level of spending isn't supported by a strong economy, but by a growing mountain of debt. So all of this brings us to the final and maybe the most important question of all. What on earth does this mean for our future? Let's boil this whole thing down to one critical takeaway. If you remember just one thing, let it be this. A loan is not income. It just isn't. When a budget is balanced this way, what we're really doing is mortgaging our future. We're paying for the things we need today with tomorrow's assets in tomorrow's earnings. And I want to leave you with this final, really powerful thought. Forget all the accounting terms for a second. Just ask this simple question. If all the borrowing suddenly stopped tomorrow, how much spending would we have to cut? The answer to that question? Well, that's the true size of the gap between what we earn and what we spend. That is the real measure of this artificial prosperity.